it's noon. So let's begin. I want to thank everyone who is joining us today. My name is John Howe-Wemett, and I am joined by Eric Dauphin of Dauphin and Fantacone CPAs. Say hi, Eric.
How you doing? Thanks for
Thank you
having
so
me.
much. Yeah, thank you so much for joining us. And I just before we get started, I want to share our normal disclaimer with everyone. So Eric and I are doing this as an educational webinar. We're trying to help you to understand a little bit about just taxes in general, not your taxes in specific, not your financial situation in specific. So if you have particular questions about your situation, you should talk to your financial planner or your tax preparer. Ask them the questions that you have that might result from this. Of course, we're happy to answer questions for you at the end of this webinar, but just realize that this is not financial or tax advice. We're just doing this for educational purposes. All right. And with all of that said, again, I want to thank you, Eric, for joining us today. And why don't you tell us a little bit about your team and what you guys do?
Sure. So we're a small firm in Syracuse, New York, and on our tax side, we work with personal clients and small businesses. So we deal with anything from rental properties and small LLCs to larger multi-member partnerships, S corps, C corps, and then we do financial statements as well. So we started in 2021, right during COVID, and just grown since then, and we're still trying to figure out exactly how we want to specialize. So we deal with everything at this point.
Yeah, okay. And do you deal with folks who live out of New York State as well as people who live in New York State, correct?
Oh yeah, and
Yeah.
I'd say that when we started, probably there were a lot more of them that lived in New York State that have since moved to usually warmer climates.
Yeah, back to our conversation about the harsh winters up here.
Yeah,
Um,
exactly.
yeah, I know that a couple folks on this call have are former New York residents, and it's a very common thing for us to transplant when we decide that the cold no longer works for us.
Yeah.
So so one of the reasons why I wanted to put on this webinar was because I feel like there's a lot of confusion about taxes. Taxes are pretty complex. They tend to kind of sneak up on people, and the truth is that we never actually are taught about them in school, right? Unless we go to school for accounting or something along those lines. And I think I talk to people a lot about taxes because they hear that I'm a financial planner and they want to kind of pick my brain about them. And with all the tax changes that have been happening in the past couple of years, there's just been increasingly more confusion. And one of the things that I get the most is people coming to me saying, John, for some reason, my tax results changed significantly between these past 2 years, and I don't know why. I was wondering, Eric, if you might, to start, share some insights or some of your thoughts about, why people might be having surprises in their tax results.
Yeah, and we've gotten this a lot too recently. I mean, we'll have clients that, even start their own return in TurboTax. They've typically done it themselves. They see what is coming out and they don't like it. So, they'll reach out and either start working with us or try to have us review it. So, yeah, we've seen it a lot. I think usually the biggest and simplest thing that I usually see is just the W-2 withholdings, specifically the federal withholdings. There's a checkbox on your W-4 that, if you have multiple jobs in the household, you can check that box. There's some tables you can work with that tell you if you need additional withholdings. But, I would say, work with a professional, or, kind of research it yourself. But that's usually what we see is, the pay stubs are not withholding according to your actual situation. So when you get to the return, that's when you're gonna, either be over or sometimes underpaid.
Yeah, that's a good point too, and that can also be the case in my experience for retirees as well. So when we're doing distributions from a retiree's IRA or their 401k, they can choose what tax withholding they're doing, and a good if we're working with a client's accountant to kind of manage their tax situation, we can sort of modulate that withholding so that we're making sure that we're kind of avoiding underpayment penalties, and but also not taking out too much money to the point where we're kind of taking the wind out of the sails of the retirement account as well.
Right.
Um, yeah.
Yeah,
So
and I mean, even in addition to that too, if on your side, you might be withholding correctly on those distributions that you know about. But what I typically see too is then on the Social Security income, there's no withholdings, so they're hit with that surprise. Um, and neither you or I can change those, so they have to go, change those for themselves if they want.
yeah, that's a good point too, is that we, as accountants and financial planners, we only have the information that we're provided, right?
Yeah.
Um, I mean, you guys, you get more kind of the whole income picture. We get what we're given. And so that's part of why it's so important to work with an accountant on when we're doing comprehensive or holistic wealth planning for someone. We like to work with accountants to try to make sure that we're understanding the whole tax situation and the whole financial situation.
Right.
Yeah, absolutely. So withholdings are really important. Can you talk a little bit more about how someone might want to look at filling out their withholding paperwork when they have a spouse that maybe has income that they're earning, whether that income is higher or lower or equal? What should folks be looking out for?
Yeah, so without getting, like you said, too specific for anyone's situation, I mean, the big thing is changes, right? So if you were both single and you get married, you'll want to talk to someone about making that change because, the single rates are pretty high. And if you both leave your withholdings, you get married, you might have a big overpayment that next year, which might sound good, but I'm sure you and I later will talk about the issue with the overpayments. And then, if you had multiple jobs and you're going down to one job or vice versa, that's going to definitely change how you're taxed. And, if your withholdings aren't adjusted accordingly, you may have big underpayments or overpayments. So,
Yeah,
yeah.
yeah. Can you tell me a little bit about underpayments? I mean, I've talked to some folks who have recently been coming up against this question, and a lot of people aren't actually aware that there can be an underpayment penalty on their taxes. Can you just talk kind of generally about underpayments and the penalties?
Yeah. So, I mean, generally, the IRS would expect you to have, paid in what you would have paid in last year. Um, and so, if you're not even close to that, you're going to pay underpayment penalties on that amount. And so if you're consistently reaching, you have 10, 15, $20,000 due with your return, a portion of that is going to be underpayment penalties. So you want to avoid that, even if not just for having a large surprise in April. That's what I find is the biggest pain point for clients is not always just the tax bill itself, but not knowing that's coming. Um, so I think, your best situation is if you can, I recommend looking at your taxes about twice a year at least. But I say, around November time, you can do some tax planning, work with a professional, or just kind of review your stuff yourself, talk to your financial advisor. There's a lot we can do. And then again in April, because if something is wrong, you want to catch it, right away for that next tax year.
Yeah, and that's a great point too about looking at your tax situation multiple times during the year. It seems for folks who haven't gone through the financial planning process before, it can seem like a lot to to go through that process multiple times. But really getting for the financial planning process, it helps us to have an idea of what your tax situation is going to be at year end, for things like capital gains. If we need to take a look at harvesting some losses, or if you're in a lower tax situation than you thought you would be, kind of maybe taking some gains that we've been holding off on taking in non-retirement accounts to kind of to move that along so that we can get towards our target allocation.
Yeah.
Knowing what we can do for Roth conversions or even IRA distributions ahead. Roth conversions are really big, especially with the changes to some of the rules around how IRAs are handled at death. So we've been working with a lot of clients on looking at Roth conversions as a more efficient estate transfer vehicle. But of course, we can't know how much to do for a Roth conversion until we know what the tax situation looks like, right?
Right. Yeah. And that's something too. Roth conversions are a big one. Like if you're, if you have a tax advisor, connecting them with your financial advisor is going to be very important to get that picture right and make sure that you're not only staying in compliance, but getting the best tax outcome you can.
Yes. Yeah. Yeah, absolutely. We can say that it might be a good idea to do a Roth conversion, but we can't tell you how much. That's what we need the accountant for.
Yeah,
Um,
exactly. And I can tell you that maybe it'd be a good idea, but I can't tell you how to do it or, I
right.
can't do it for you. So got to
Yeah,
talk to your advisor.
yeah, it's one of the things that I really love about this profession is that it's cross-disciplinary, and I get to work with great people like you, Eric, great accountants. I get to work with estate planning attorneys, any number of professionals that are on someone's wealth team. I get to work with, and that's really enjoyable. But I feel like taxes are such an important piece because they impact everyone, right?
Yeah. Oh, yeah.
And this is something we should have learned about when we were younger because everyone's going to experience it at some point in their life, probably sooner than they'd like or to a greater extent that they'd like. um,
Right.
so yeah. So I guess what are some other things that you've seen in your practice that maybe were surprising to you or that you feel like some clients should be aware of, that they're consistently not aware of?
Yeah. So, I mean, the withholdings and the W-4, and, especially those that are in multiple states now,
Mhm.
that's more and more common. Just you're working in one state, living in another, or you're, for whatever reason, your, W-2 is allocating the income to multiple states. So that's a big one, and being familiar with that and how it's taxed so that you don't run into any state issues because the states are increasingly, I'd say, aggressive in collecting their own tax, especially New York. So, that's a big one. And then I think your carryover losses. So if you have losses from previous years carrying forward, that's a big one. I try to make clients aware that they typically don't think about because they're not on their return or maybe not causing a big tax effect that year. But if we bring that to their advisor and let them know, hey, advisors would typically be hesitant, right, to take big gains if they can leave it in because they know the tax bill is coming from it. So you want that value to go up, of course, but to take gains, you don't want them to be hit with the tax implications. Whereas if we, let them know that, hey, you have 30,000 in carry forward losses, that allows their advisor to kind of really let loose and sell out of things if that's what's best or reallocate.
Yeah. Yeah, that's a great point. I can't overstate how important it is from an investment management standpoint for us to be aware of what your loss or your loss carry forward situation would be, especially if we're looking at kind of a rebalancing of a portfolio. We need to know what your tax situation is so that we're not necessarily dinging you or we're not making choices that would impact you from a very significant standpoint. Can you
Right.
talk a little bit, just very high level, about the difference in capital gains taxes, and kind of explain what a capital gain is for us?
Yeah. So, I mean, when you sell out of a stock, for example, you have your purchase price or you have your sale price and your cost basis. And so your income on that is, a capital gain and it's taxed at a lower rate typically than your income tax. So it's advantageous when possible to allocate more of your income to those taxable accounts versus just a W-2 income or, other ordinary income. So, it's even when, sometimes I'm sure you hear from clients the complaints that, you gave them a lot of capital gains, now they have to pay the tax, and yeah, sometimes that hurts, but, we try to tell them that, hey, it was a lot lower rate than ordinary. And, if you can get even more of your income towards those, whether it's dividends or capital gains, you should try to do that.
Right. And what a lot of people, so I'll say a couple things about this too from my practice is that it a lot of people forget, I think, just because no one really enjoys paying taxes, right? I've not yet met someone who's like, yes, I get to pay my taxes this year. Um, but I think that what we need, so the negativeness of having to pay taxes kind of overshadows the positive feeling of the fact that you made money,
Yeah.
right? Because capital gains are the difference between what you purchased the stock or the security at and what you sold it for. So if you have a capital gain, that means that you've made money on that purchase, right?
Yeah.
So which is a good thing, right? We've got champagne problems. Um, and it's a but at the same time, it's not lost on me that that sale still creates a taxable situation. It still can create a taxable event for folks. Um, so we just need to be cognizant of that. And one of the other things that I think that folks should be aware of that they might not necessarily be aware of who are investing is that if you're investing in mutual funds, at the end of the year, what you might have noticed is mutual funds, they tend to pass along long-term capital gains to you as the investor. So as you hold them, around October, November time, the mutual fund companies start putting out their estimates for what their capital gains distributions are going to be. And they can be a significant portion of your holding within the asset. So you're sort of receiving income from the mutual fund, which is nice. But at the same time, you have to pay tax on those capital gains distributions.
Right.
Um, so that's another thing that kind of gives us a moment where if we're at the end of the year and we hold mutual funds, we need to know what the tax situation is, and we need to work with our advisors to make sure that if the advisor's planning on getting rid of a mutual fund anyway, and that mutual fund is going to be paying out capital gains distributions, well, maybe we get out of that mutual fund before the capital gains distribution hits the account, right?
Yeah. And I think another big piece is, they're making the income in the capital gains and it is taxed, and that's fine, but a lot of times they don't see the money, so if they're not withdrawing any funds from that taxable account, in their eyes, they didn't make anything. They didn't see, nothing hit their pockets. So being hit with a tax bill hurts that much more because unlike your W-2 that's going into your bank account, you see it every week. You didn't feel the benefit of any income, so to then just have the tax bill and have cash go out for that is a lot of times surprising to clients in March or April.
Yeah, yeah, that's a really good point. That's a really good point too. Yeah, because it's not like with your W-2 income where you have money coming into your bank account, and so it kind of softens the blow. But
Yeah,
with these capital gains distributions, that's just not the case.
right. Yeah.
Yeah, absolutely. So I want to ask you a little bit about kind of some of the advantages of working with an accountant and some of the challenges that you might experience with that. Is it a so my thought, and maybe a lot of the thought of a lot of other people too, is that I it would be really nice for me to be able to work with an accountant, but I do it on TurboTax or whatever, and so how much more value could I possibly be receiving for that? So how would you kind of respond to that?
Sure. So I would say that, not everyone needs to work with a CPA or even a tax preparer. And there's plenty of people that can use a TurboTax. But I would say that like anything, there's essentially levels, to the difficulty of taxes, and depending on what you want to achieve, you may need to work with a professional. So I would say, nowadays with all the changes in the tax law and the complexities, especially in New York State, if you have a business or an LLC or a rental, I really recommend working with a professional. I think you are leaving some savings and opportunities on the table. So beyond that, for those who do W-2 and have retirement, I would say if you're fine with things the way they are, and you put it in, you're fine with the outcome, you contribute to your employer plan, you're probably okay, on your own or using one of the provided software through the IRS. If you do want to do a backdoor Roth, or you want to do something a little bit more complicated, I think it's important, to work with your advisor, not just during tax time, but really all year, because we definitely don't have time between February and April to have a lot of deep conversations or come up with new strategies. So I think reaching out during the summer, the fall, planning time is great. Connecting us with your advisor throughout the year, you gotta, crawl before you walk and before you run. So, I really think that, if your withholdings aren't right, it's going to be tough for us to have a deep enough relationship uh, to get you into some of these more complex strategies. Um, and it's going to be tough for you to maybe follow through on them as well. So I think starting small, starting with something, having the conversations, and kind of having someone guide you through is good for those that want to do better.
Yeah, I definitely agree with that. I think that one of the things that people really struggle with too is implementation. Um, we can recommend great strategies. We can have the best financial plan or the best, tax plan put together. And I don't know if you feel the same way, Eric, but sometimes what I experience is this great plan that we have, the clients, they don't execute. And then we end up kind of in a similar situation. Again, do you ever run into that?
Oh yeah. Yeah. And I mean, we try to, see that up front and catch it up front, but if someone doesn't make their estimated tax payments, or maybe they only speak to us for 5 minutes a year and we file their return, um, you know, but then they come asking if they should maybe put their child on their payroll to save on, taxes. It's not something I recommend, because, the more diligent you are, the more opportunities there are and the more you can strategize and save. But if you're not there yet, it's usually worse off than doing nothing.
Yeah, yeah, that's a great point. One of the other things that I definitely wanted to make sure that we talked about was we talked a little bit about underpayment. So obviously it's tough when we owe a lot after we're done kind of going through the process of figuring out what our tax liability is. We haven't paid enough in. There might even be penalties associated with that. I think that some people on the call, they might think, or some people who are watching later on, they might think, well, I'll just withhold a ton so that way I'll never run into underpayment and I'll never have a problem. What are some of the issues that you see with folks who have kind of these large refunds at the end of the year?
Yeah. So one of the big issues, of course, is what could you be doing with that money throughout the year, especially with interest rates being as high as they are. If it was in even a savings account or a CD, or of course in one of your taxable accounts, um, you're losing out on money there. Another big one is your money is in the hands of the IRS or the state, depending on the situation, and it's never a good place for your money to be sitting. So they give it back to you really when they see fit. I mean, refunds, typically it seems like over $10,000 get a second set of eyes on them, so they're going to take longer reviewing that return. They may have concerns about identity theft. With big returns, could be someone else filing for you. So that's what we try to avoid. I think a couple $1,000 overpaid is fine. But you really don't want to be waiting for $10,000 or more from the IRS, because I have seen it take 6 months to a year. Maybe sometimes they ask for some follow-up information, but even then, yeah, it takes a long time often.
Yeah, and there's one thing that we do know from the past couple of years is that the IRS is bogged down,
Oh yeah.
um, understaffed, underfunded. So they've been trying to ramp up and they've been trying to do better from what I've heard, but it's still a challenge. Um, to
Yeah.
your to your point, one of the things that I've said in one of my videos is that if you are basically holding off, or if you're getting a large refund at the end of the year, that means that you've been basically giving the government an interest-free loan, right?
Yep.
So one of the things that I would advocate for is to work to have an appropriate amount withheld from your wages, or from your retirement accounts if you're someone who's in retirement and taking distributions. Figure out what a good tipping point is for you. It doesn't necessarily mean that I'm not implying that you should owe or you should get a refund. It's kind of a personal thing, right, Eric?
Yeah, yeah. I mean, there's something to be said about, again, waiting on your refund versus, as long as you're not underpaid or you're not paying significant penalties, if you owe $1,000, you write the check, they cash it, or they take it from your bank, you're done with them. You
Right.
know it's complete, you know that you're not waiting on them for anything. Whereas the other way around, it's a guessing game. Um, yeah,
Yeah.
that would be, one of the big differences.
Yeah, and the thing is too, if that $10,000, or whatever your refund is, if it was sitting in, as you said, Eric, in a high yield savings account or something along those lines, high yield savings accounts have really come a long way in providing interest rate return for the money that you have in them.
Yep.
It's not uncommon to see interest rates now between 4.5%, 5% very easily from reputable online banks.
Yep.
Um, Also, like you said, CDs can be an option. Um, from even I've seen some local banks or some larger banks offering CDs in the 5% range. So we're not in the same interest rate environment where you couldn't go anywhere to get any type of interest on your money. So why not just give it to the government for a while, and then you get that feeling.
Yeah.
You kind of trick your brain into, well, I've got this extra money coming, even though it's really your own money, right?
Yeah. Yeah. And I think, probably wouldn't be a bad idea if someone was, let's say, they get a big refund, so they're over withholding, a few $100 a month. Talk to your advisor, and is there a way that you can automate, maybe a savings to, whether it's high yield savings or even a taxable account, um, or a retirement account, so you can still kind of get it out of your mind, get it out of your pocket, but you're doing something smart with it.
Yeah,
Um,
yeah. Some of these
yeah.
high yield savings accounts, they act just like savings accounts that you have at your bank. You can actually do direct deposit from your paycheck right into those accounts, and then that money just kind of sits there. And as it's growing, or as you're waiting to implement it for whatever your need is, whether it's your emergency fund or for taxes, it can just continue to grow, and of course the interest continues to grow as well. Um, which
Yeah.
is it can be a really great tactic for helping you to increase. It's not going to change your life necessarily, but over a body of time, the more money that we can keep in your pocket and in the client's pocket versus going to the government or going elsewhere, or just having the opportunity cost of it not earning you any interest, that can be a win for you if over the long term.
Yeah, I think, the biggest key though is, if you do end up with a surprise, whether you filed already or not, understanding what the reason is for that overpayment or underpayment. Because, I mean, I see a lot more and more now when you change jobs, especially high earners, they may be hitting that Social Security wage base, and then they start a new job, and that, they start withholding Social Security again.
Mm,
So, multiple times this year already, I've seen huge overpayments, but, I tell them, don't adjust your withholdings because this isn't going to happen again next year.
right.
Um, or, on the other side, you'll see people, maybe they're underpaid, but they had a large large amount of capital gains from their investment statements. Again, maybe it's a one-off and they're not going to have that next year. So, you know, I, I'm hesitant to tell people to make adjustments too quick. Let's figure it out. What is going on? Maybe that won't happen next year, or maybe it will. But
Hmm.
yeah, just kind of work with your advisor on both of those.
Yeah, that's a really great point to be aware of, is that job changes can really influence your tax situation, especially for higher wage earners.
Yeah,
Social Security taxes are an interesting beast, and it's stuff that's pretty deep in the lexicon of financial planning too. So getting to a financial planner who knows what they're doing, and who partners with great accountants, who
yeah.
can help you to make sure that you're aware of that, and that you don't make significant changes based on one particular year if you don't understand why you had an outsized tax year.
Right. And then, by the time you see it, let's call it April, it's important to know that you're already, if there is a change needed, you're already 4 months in, right? So if you're on pace for underpayment, you're going to have that carrying into that next year already, or overpayment, same thing potentially. So, I would say setting your expectations for that as well, that you fixed it, but you fixed it quarter through the year already.
Yeah, that's a great point. And that actually leads us right into the next question that I wanted to ask you. So, so let's talk a little bit about employer-sponsored retirement plans. When I teach my retirement planning class at St. John Fisher College or University now, I always tell my students that retirement planning and tax planning are inextricably linked, because of the fact that your retirement counts are one of the very best ways to control your tax liability while you're working. So can you talk a little bit about kind of the strength of an employer-sponsored retirement plan for kind of modulating your tax liability, and also obviously for saving for the future?
Yeah, I mean, W-2 wage earners, they kind of have the least amount of flexibility in terms of tax strategy and savings, unlike business owners. So I think really one of the key points is those retirement plans that their employer has. So, usually there's a match typically now. Companies have almost been forced to do that to recruit. So anytime you get a match, it's a no-brainer. You want to at least hit that. And then just there's no income limits. So unlike strategizing with Roths or IRAs or SEP IRAs or anything like that, there's no income limit, so that you can contribute to that plan. And then, of course, the only thing to be aware of is, unlike the IRAs and things like that, the cutoff is 12/31/20, for this year 24. So having those conversations earlier, like I mentioned, looking at it in November or even earlier, what can you contribute for the year to get that tax savings? Because once you get to tax time, there's nothing you can do at that point.
Yeah, that's a really great point, and I'm glad you brought that up about the kind of the deadline for making contributions to those employer-sponsored retirement plans. One of the things that I get asked the most is, I've got a chunk of money. How would I employ it into the market, right? And if that's a client of mine, one of the things that I look at first is, are you maxing out your employer-sponsored retirement plan contributions? If you're not maxing out your employer-sponsored retirement plan contributions, why don't we try bumping up the distributions, or not the distributions, but the contributions from your paycheck? So you're taking home a smaller paycheck, and what you end up doing on the backside is you live off that money, that chunk of money that you have, right? So if you have a differential between your living expenses and your paycheck, you take it out of that chunk of money that you would have invested into the market, or that you thought you had earmarked for investment. And what that does is it effectively moves the money from that account, that after tax money. It utilizes the before tax savings, as long as someone's doing it on a pre-tax basis,
Hmm.
and it reduces your tax liability, while at the same time getting you exposure to the market, however you're invested within that employer-sponsored retirement plan.
Right.
Um, because there's just no way, just like you said, unlike with IRAs, we don't have until the tax filing deadline for that tax year to be able to make those contributions. There's no way really for us to just take a chunk of money from our bank accounts and toss it right into our employer sponsored retirement plans in most circumstances.
Right.
Um, so that's a strategy that I've found, but it is very, in my mind, it's important to remember that when you make a contribution to your employer sponsored retirement plan on a pre-tax basis, it's really a dollar for dollar reduction of your taxable income, right?
Yep.
Yeah.
Yeah. And I think, for us, it's tough because even, the IRAs, you have till the tax deadline, but again, we're pretty busy, so we can let you know what that is and maybe you can alter your return, but on your, we don't know their full financial picture or what kind of plan maybe that their family or their advisor has put in place. So, whether it's an IRA or a SEP IRA, again, we can give you that number that will help with your taxes, but you know, maybe taxes aren't saving on taxes isn't as important, as saving for that first home or medical expenses, things like that. So I think having that team on board is key.
Yes, yeah, I agree with that completely. To the point, since we're talking about IRAs, I do want to touch on IRAs a little bit because there's a lot of kind of obscure rules when it comes to making contributions to IRAs and the deductibility of those contributions, right?
Yeah.
Um, so can you tell us a little bit about some of like the income? You don't have to give the exact numbers, but give us an idea of the concept of, how the deductibility of traditional IRA contributions kind of goes away above a certain tax liability or a certain income threshold. And also talk a little bit about the different rules depending on who's covered by an employer-sponsored retirement plan at work.
Yeah. So, I mean, in general, I would just say too, w- we get a lot of the quick questions, you know what I mean?
Yeah,
So we get a lot of calls and emails with the quick question, can I do this or what's the max on this? And it really is true that there's no quick question anymore. And unless we have the full picture too, it's hard to give, real answers. So, I mean, of course, the contribution limits change each year, so you can't get used to those. And then people want to contribute, and you find out they got married, and if their spouse is covered by a plan, that income limit will kick in, and they're not allowed to contribute. So, we may need to find a workaround there. So I would just say, like you said, there's so many nuances, and that really is, you talked about when someone could do it on their own versus talking to a professional, and if you're doing these strategies, I would say outside of your employer, that's when you need to work with, at least a financial advisor, preferably a tax account too, and hopefully, both. But yeah, so that's what I would say. There are income limits that kick in when you or your spouse are covered. Um, and there's you can contribute more if you're over a certain age, um, and maybe you do have some self-employment income that we can maybe contribute more through a SEP. So it's not just can you or can't you, it's how much, is it deductible, and is there a better option maybe to get that retirement savings?
yeah, yeah, absolutely. You said it. You said it. I couldn't have said it better myself. It's a tangled web, really. And I picked that because I think it illustrates perfectly how something that seems simple in people's minds. Well, if I make an IRA contribution, then that'll save me money on my taxes, right? Well, not necessarily.
Right.
There are a lot of circumstances under which it won't help.
Yeah.
So it's definitely important for you to, if you are uncertain, there's nothing wrong with engaging someone to do the service for you. There's it, and in fact, it might be able to save you money in the long run because they might someone who really knows what they're looking at in terms of being able to look at your taxes and sift through them might be able to find you things that you didn't necessarily know about before, right?
Yeah.
Um,
Yeah, and I
and
think, how much is it saving too? Because we'll see, some clients can max it out and they save roughly 10%. And others, I mean, we've seen up to 40% depending on what else they have going on and their age and how much they can contribute. So, that's a big key because it may not be worth it for that taxpayer depending on how much they are getting a return currently.
Yeah, yeah, absolutely. One of the other things I did want to ask you about while you're here, and I'm hoping that this will be helpful for people, is I want to talk a little bit about health savings accounts or HSAs, because they're kind of increasing in popularity. Ever since I got into the industry, they've kind of been increasing and increasing in popularity as more companies adopt high deductible health plans. Um, and one of the things that I like about HSAs is that they're portable, right? It's not really linked to your employer. Of course, it's kind of in a convoluted way. It's a result of being involved in your employer. It might be a result of being involved in your employer-sponsored retirement plan or your employer's health care. But it's something that you can take with you, and it has a couple of really key advantages that might be able to help you when it comes to taxes, right, Eric?
Yeah. So, I mean, I'm a big fan of the HSAs. So, especially nowadays, with people switching jobs, or maybe you're self-employed, or you can get it from the marketplace. Health insurance itself is becoming a little bit more portable. And then these high deductible plans are pretty popular. So, being able to have a plan that, people don't like feeling so tied to their employer a lot of times. And so having this plan that can move with you, whether you're on the marketplace high deductible or with your employer, being able to carry over those funds is huge. That money's not going away, you're not losing it, so you can contribute. And then with medical costs going up, there's less concern of, am I ever going to use this? And if you don't, you can take that all the way into retirement. So the other thing is it does give you that flexibility in terms of, you can contribute pre-tax through your employer and get the benefit right there and have it automated. But you can also contribute post-tax all the way up to the tax deadline, even if you're extended. So having that, you can get your return done pretty early, which I kind of recommend at least having the bulk of the information in, because then you can work with your accountant or your advisor to see, all right, now what are my options?
Yeah.
So having that in there and saying, you know what, this is what my tax bill's looking like, but if I contribute this much to my HSA, it brings it down, and it gives you a little bit of wiggle room at the end of the year to be able to not only make a smart, financial decision towards healthcare, but also, you know, save a little bit on the tax bill.
Yeah, yeah, that's perfectly said. I love HSAs because they work like IRAs, like you said, in the sense that you can make contributions until the tax filing deadline.
Yeah,
So it's one of the key ways that you can kind of modulate your tax situation after the fact. Um, and unlike the IRAs, there is no income limit for making those contributions and having them be tax deductible, right?
right. Yeah, no income limits. And I would say, if you are in a high deductible plan, you know, I would definitely look into it because, it doesn't necessarily have to cost you anything, and maybe you only put in, $1,000 or so the first year, but maybe you utilize it down the road. But you can't, once the year has passed, you can't just open it up in April and contribute. So it does have to be, you do want it open
Hmm.
for that previous tax year. So if you're thinking about it for 24, I would say do it now or shortly, because, when it comes to tax time next year, it's going to be too late to do that. So you're always kind of a year lagging, at least in terms of setting it up.
Yeah.
And then keep it in mind, if you're not in a high deductible, maybe the next time a qualifying event comes up, you may want to change your health insurance to be on a high deductible plan.
Yeah, absolutely. From a pure, net worth or cash flow standpoint, high deductible health plans, they can be they've kind of been villainized because they feel expensive, because you're paying for a lot of your expenses out of pocket. You can use an HSA to pay for those expenses pre-tax, which is nice. But one of the things that people don't think about a lot with high deductible health plans is that because the deductible is high, because you're not in a situation where you're making copays, your actual your regular premium that comes out of your paycheck is typically so much lower than it is for a traditional healthcare plan.
Yeah.
Um, and that what I've always thought for high deductible health plans is that they kind of help folks that are in the two extremes of healthcare, either people who don't really use their healthcare or people who use their healthcare a lot and would typically reach the upper bound of that deductible. So it's kind of preventing from the catastrophic loss, and then it's also helping people who don't use healthcare to save money on their regular premiums that come out of their paycheck.
Yeah, and a lot of employers now, I've seen are covering a portion of that HSA. So if you join our high deductible plan, we'll put in the first, $1,400 or so to your HSA. So you kind of get the benefit there as well.
Yeah, yeah. And the other really nice thing about the HSAs is that they can reimburse past medical expenses too.
Yep.
There's,
Yes. As long as that plan was open when you had them, you can contribute after and kind of reimburse yourself, or, depending on what payment method you made at the doctor or anything, you can just take that out of your account and pay yourself back. Just
yeah,
keep all those records.
yes, yes, absolutely. Because there is a penalty for using those funds for something that's unapproved, right?
Yep. Yeah, you'll have that you'll have to pay tax, and then you'll have to pay that 10% penalty as well.
Yep, yep, absolutely. And I've seen some of these companies lately, like these wearable companies, they've come out and they've said, "Oh, we're HSA approved now." And it's like, well, okay, if I trust you to say that, it's the IRS isn't going to come back to you if I file my taxes saying that, I paid for this $700 wearable or something like that out of my HSA. They're going to come back to me. And if I say, oh, well, they said it was approved on their website, they're going to say, well, that doesn't matter. We're upset with you because it's not. Um,
Definitely.
so definitely just be careful when you see these advertisements to make sure to do some research, because there are definitely categories that qualify as qualified medical expenses for HSA purposes and some that don't.
Yeah, and I mean, there will be plenty of expenses along the road. I'm sure that, this money doesn't go to waste, and if you bring it into retirement, then, so be it, but you'll probably have plenty of expenses then as well. So,
Yeah, yep,
uh, and if
absolutely.
not, then, maybe it's not worth contributing, and you're better off kind of putting it in maybe your retirement or another account.
Yeah, yeah. And what you can do too, what some people don't realize is that a lot of HSAs, they have investment options as well. So you can, if you have a big balance in your HSA and you feel like it's not growing, look to see if there's an investment option within that. And then you can talk to your investment professional to try to help you figure out what a good asset allocation or what the from the list of securities that are available within that HSA, what might be a good way for you to invest that. Um, that's a that's a
Definitely.
that's a cool little feature that I don't know
Yeah.
if a lot of people know about.
Yeah,
Yeah,
definitely.
yeah. Well, we're coming up on if you can eat. Time flies when we're having
Yeah.
fun, and
Yeah.
I've been having a great time with you, Eric. Um, so I guess let's talk just briefly a little bit about kind of what people should be thinking about for 2024, and then we'll open it up for some questions. If you have questions, put them into the chat. We'd love to answer any questions that you have. But yeah, Eric, a little bit about looking ahead to 2024, what folks should be looking at.
Yeah, I would say now as you're filing your return, of course, if there's anything you can talk to your tax professional or your financial advisor about, making changes that may make your return a little bit better or make you owe less, you can always continue to optimize. So is there anything you can do for 23 still? And then number two, looking at your results, is there anything you can implement now that will already impact 2024's taxes when you're filing in 25? Now is the time. If you don't do it now, it's not going to come up in June. So that's my biggest recommendation. And then if there's things that you're unsure about, maybe you can't get a hold of your tax advisor, you can't get a hold of your investment advisor, or you're not sure of how much you want to contribute, you can do a tax extension, which gives you more time. you have to be careful there because it's always an extension of time to file, not to pay. So if you are going to have to pay in or you feel like you're going to owe, you still would have to make that payment with the extension, but it gives you, 6 months to, maybe make some strategies with your team and implement them and save on some tax money.
Yeah, that's a really fantastic point. Um, it's really vital for us you said the word optimize, and I love that word, because that's really what we do in financial planning, and in tax planning as well.
Yeah.
We work hand in hand to make sure that things move efficiently, that we're trying to save. It's not just about investments, right? We're not just trying to maximize the investments for you. We're trying to optimize your entire financial life to increase your net worth, hopefully, in other ways that aren't just related to the investments. Everyone loves the investments because they're exciting, and you can just turn on the TV and people are talking about investments or the company that you're invested in. But there's a lot of work to be done in financial planning and in tax planning that's very important as well.
Yeah. Yep. And now is definitely the time to start thinking about the current year.
Yeah, yeah, absolutely. All right. Well, are there any questions that anyone has? I'm not seeing any questions in the chat, but I'll give everyone a second to see if they have any questions. Eric, why don't you tell us a little bit about how folks can get a hold of you, or what your website is, and all that.
Yeah, sure. So, I know you gave me a good shout out on the social media there.
Yeah.
So, we're on LinkedIn, both me and the firm. You can find us on our website, df-cpas.com. Um, and yeah, we'll be happy to help out at this point, for next year.
Yeah.
Yeah.
Yeah, that's very fair. And if anyone who's connected with me wants to get in touch with Eric, please let me know. I'd be more than happy to point you in his direction, make the connection for you. But Eric, I'm not seeing any questions
Okay.
in the chat here. So we're going to let you go, but thank you so much for joining us today.
Yeah, thank you
Um,
for having me.
and I hope that we can do another one of these again in the near future. This was great.
Definitely. Yeah, we'll get maybe deeper on certain topics. Yep.
Yeah, that would be fantastic. All right. Well, thank you so much for your time. Thank you everyone who joined us, and look for this recording on YouTube. And thanks everyone so much. Take care.